On October 15, 1929, one of the most respected economists in the United States stood before a crowded room of wealthy investors and made a prediction that would haunt history. His name was Irving Fisher. He was a professor at Yale. He was a celebrity. And he looked at the booming stock market, the roaring economy, and the incredible technological advancements of the 1920s, and he said, quote, "Stock prices have reached what looks like a permanently high plateau." He didn't just say the market was good. He said it had fundamentally changed. He believed that the old rules of gravity no longer applied because technology, specifically radio and electricity, had unleashed a new era of infinite productivity. 9 days later, the market crashed. By 1932, the Dow Jones Industrial Average had lost 89% of its value. The permanently high plateau became a graveyard of wealth. Millions of families lost their life savings. The Roaring Twenties died, and the Great Depression was born. Now, fast forward 96 years. It is 2025. Open your news feed. Turn on the television. What do you hear? You hear that we have achieved a soft landing. You hear that artificial intelligence has unleashed a new era of infinite productivity. You hear that despite high interest rates, the consumer is strong, the stock market is at all-time highs, and house prices will never fall because there is a shortage. Does this sound familiar? It should. Because if you strip away the color television and the smartphones, and you look strictly at the financial mechanics underneath the surface, the year 2025 is not just similar to 1929, it is a mathematical mirror image. We are living through the Roaring Twenties all over again. And just like our ancestors a century ago, we are ignoring the exact same 4 warning signals that flashed right before the floor fell out. These are the ghost signals. They are the quiet, structural cracks that appear when an economy is built on debt and hubris. In this deep dive documentary, we are not going to give you a history lesson. We are going to perform a forensic autopsy. We are going to place the data from 1929 side by side with the data from 2025. We will expose the shadow leverage hidden in your phone that is identical to the installment plans of the 1920s. We will show you how the radio bubble of 1928 is the exact same blueprint as the AI bubble of today. And we will reveal the terrifying new casino mechanism that has replaced the shoeshine boy tipster, a mechanism called zero-day options. Most people think the Great Depression was an accident. It wasn't. It was a math equation. And today, we are solving for the same variable. Welcome to Finance Prism. Let's look at the ghosts. To understand the first signal, you have to understand the mood of the 1920s. We call it the Roaring Twenties for a reason. It was a decade of explosion. But what was exploding? It wasn't just parties and jazz music. It was technology. Before the 1920s, factories ran on steam. They were dirty, slow, and inefficient. Then came electricity. Suddenly, factories could run 24 hours a day. Productivity skyrocketed. Then came the radio. This was the internet of its day. For the first time in human history, a voice could travel wirelessly into millions of homes simultaneously. It felt like magic. Investors looked at this and went insane. They poured billions of dollars into a company called RCA, the Radio Corporation of America. RCA was the NVIDIA of 1929. Between 1924 and 1929, RCA stock rose from $11 a share to $114 a share. It didn't pay a dividend. It didn't matter. Investors believed that radio would change the world so fundamentally that profits didn't matter anymore. This brings us to ghost signal number 1, the technology trap. The trap is not that the technology is fake. Radio was real. Electricity was real. They did change the world. The trap is the belief that a revolutionary technology eliminates the business cycle. Look at 2025. What is the narrative driving the S&P 500 to record highs? It is artificial intelligence. Just like electricity, AI promises to make every worker more productive. Just like radio, it feels like magic. And just like RCA, we have a single company, NVIDIA, powering the entire narrative. NVIDIA creates the chips that power AI. Its stock price has gone parabolic, adding trillions of dollars in market cap in a matter of months. But here's the historical echo. In 1929, companies weren't just buying radios. They were over-investing in capacity. They were building factories they didn't need, assuming demand would grow forever. Today, big tech companies, Microsoft, Google, Meta, Amazon, are spending hundreds of billions of dollars on AI data centers and chips. They are engaging in a capital expenditure arms race that rivals the industrial build-out of the 1920s. But as we discussed in our previous analysis, the revenue isn't there yet. They are spending billions to make millions. In 1929, when the economy slowed down just a little bit, all that overcapacity became a dead weight. The factories went silent. The expensive radios sat on shelves. The RCA stock that was priced for perfection collapsed. It took RCA 30 years to recover its 1929 peak price. 30 years. We are seeing the same setup. We are pricing stocks as if nothing can ever go wrong because we believe the magic of AI will save us from interest rates, debt, and geopolitics. We have convinced ourselves that this time is different because we have silicon, while they had vacuum tubes. But the financial psychology is identical. We are confusing innovation with profitability, and history tells us that is the most expensive mistake an investor can make. But a stock market bubble alone doesn't cause a Great Depression. You need something else. You need a mechanism to destroy the average person. In the 1920s, for the first time in American history, it became culturally acceptable to buy things you couldn't afford. Before the 1920s, if you wanted a car or a washing machine or a radio, you saved up cash. Debt was shameful. It was for emergencies. But then corporations realized they could sell more stuff if they let people pay later. They invented the installment plan. Buy now, pay later. That was the slogan of the 1920s. Sound familiar? By 1927, 75% of all cars and 80% of all phonographs were bought on installment plans. The average American was walking around with a new suit, a new car, and a new radio, feeling rich. But they weren't rich. They were leveraged. They had committed their future wages to pay for their present comfort. They were living on a razor's edge. As long as they kept their job, they could make the monthly payment. But if anything interrupted their income, the repo man came for the car, the radio, and the furniture. This brings us to ghost signal number 2, the shadow leverage. Today, we don't call them installment plans. We call them BNPL, buy now, pay later. Services like Affirm, Klarna, and Afterpay have exploded. They are built into the checkout button of every online store. You want a $200 pair of sneakers? Pay $50 now, and $50 every 2 weeks. It seems harmless, it seems convenient, but look at the data. In 2024, the global buy now, pay later market hit $340 billion. But here is the terrifying statistic. In 2024, 41% of buy now, pay later users had missed a payment. 41%. Who are these users? They are not the wealthy. 61% of them are subprime borrowers, people with bad credit or no credit who have already maxed out their credit cards. We have rebuilt the 1920s debt trap, but we made it digital and instant. In the 1920s, you had to walk into a store and sign a paper contract to get credit. Today, you click a button at 3 a.m. while scrolling TikTok. The friction of debt has been removed entirely. And just like in 1929, this debt is invisible. It doesn't always show up on traditional credit reports. It is shadow debt. So when the Federal Reserve looks at the economy, they see strong consumer spending. They see people buying flights, dinners, and clothes. They think the economy is healthy. But they are looking at the spending, not the funding. The spending is being funded by microloans that are defaulting at record rates. The American consumer is not strong. The American consumer is using a payday loan app to buy groceries. In 1929, when the stock market crashed, businesses started firing people. When people lost their jobs, they couldn't make their installment payments. When they missed payments, the banks and stores repossessed the goods. This caused consumption to collapse. Factories closed. More people got fired. It was a death spiral. Today, if we hit a recession, the BNPL bubble will burst instantly. Millions of young consumers who have built a lifestyle on 4 easy payments will find themselves locked out of the economy. The shadow leverage is the hidden explosive charge planted in the foundation of the US economy. And just like in 1929, nobody is paying attention to it until it detonates. So we have a tech bubble, and we have a consumer debt bubble. But for the system to truly break, you need a casino. You need a way for regular people to gamble their life savings with maximum leverage. In the 1920s, this mechanism was called buying on margin. Here is how it worked. You wanted to buy $100 worth of RCA stock, but you only had $10. No problem. The broker would lend you the other $90. You put down 10% and you owned the stock. If the stock went up 10%, you doubled your money. It was magic. Everybody was doing it. The barber, the taxi driver, the shoe shine boy, everyone was trading stocks on margin. There is a famous story about Joseph Kennedy, the father of JFK. He said he knew it was time to sell the market when his shoeshine boy started giving him stock tips. When the general public enters the market with leverage, the top is in. Why is margin dangerous? Because it works both ways. If the stock falls just 10%, your entire $10 investment is wiped out. The broker issues a margin call. You have to put up more cash instantly, or they sell your stock. In October 1929, when prices dipped, thousands of margin calls went out. People didn't have the cash. Brokers sold the stocks. This drove prices down further, triggering more margin calls. It was a chain reaction of forced selling that evaporated billions of dollars in hours. Now, look at 2025. Do we have margin loans? Yes, but we have something far more dangerous. We have ghost signal number 3, the zero-day option casino. Zero-day to expiration options, or 0DTE. These are options contracts that expire on the same day they are traded. They are essentially lottery tickets on the stock market. They allow you to control huge amounts of stock for pennies. If you guess the direction of the market right, you can make 500% in an hour. If you guess wrong, you lose 100% by 4 p.m. In 2024, these zero-day options accounted for over 50% of the total options volume on the S&P 500. Think about that. Half of the volume in the most important financial market in the world is now people gambling on what the price will be in the next 6 hours. This is not investing. This is not even trading. It is a slot machine. And who is playing this game? It is the modern equivalent of the shoeshine boy. It is the retail trader on an app trying to get rich quick because inflation has made it impossible to get rich slow. But the danger isn't just that these people will lose their money. The danger is structural. When you buy an option, someone has to sell it to you. That someone is usually a market maker, a big bank or hedge fund. To protect themselves, these market makers have to buy or sell the actual stock as a hedge. This is called gamma hedging. When billions of dollars of zero-day options are traded, it forces the market makers to buy and sell billions of dollars of stock instantly. This creates massive volatility. It can make the market shoot up out of nowhere or crash out of nowhere. In 1929, the leverage was 10 to 1. Today, with options, the leverage can be 100 to 1. We have turned the US stock market into a derivative of a derivative. We have built a skyscraper on top of a fault line, and we are jumping up and down on the roof. If a real panic starts, if a war breaks out, or a big bank fails, this gamma mechanism could cause a flash crash that makes 1929 look like a gentle correction. The machinery of the market has become too fast, too leveraged, and too fragile. We are driving a Formula One car on a sheet of ice. But there is one final signal, the deepest, most structural signal of them all. The Great Depression wasn't just a financial event, it was a social event. It happened because the economy had become fundamentally unbalanced. In the 1920s, productivity was booming. Factories were efficient, profits were soaring. But wages? Wages were flat. The rich were getting astronomically richer, while the working class was taking on debt just to buy the things they were producing. By 1929, the top 0.1% of Americans owned as much wealth as the bottom 42% combined. This is ghost signal number 4, the inequality gap. When wealth concentrates at the very top, the economy becomes fragile. Why? Because the rich can only buy so many cars, so many radios, and so many houses. An economy depends on the mass spending of the middle class. But if the middle class is broke or drowning in debt, who buys the products? Eventually, the demand dries up, the inventory piles up, and the house of cards collapses. Look at the United States in 2025. We are at the exact same level of inequality as 1929. The top 1% holds a record share of the nation's wealth. Corporate profits are at all-time highs. But real wages for the average worker have barely budged in decades when you account for the cost of housing, education, and healthcare. We have hollowed out the middle class. We have replaced savings with credit cards. We have replaced pensions with hope. The roaring 20s were only roaring for the people at the top. For everyone else, it was a struggle hidden by installment plans. The AI boom of the 2020s is exactly the same. The shareholders of Nvidia and Microsoft are becoming multi-billionaires. But the average software engineer is worried about losing their job to ChatGPT. The average graphic designer is watching their industry evaporate. We are building an economy that works incredibly well for capital and incredibly poorly for labor. This imbalance is the fuel for the fire. It means that when the recession comes, there is no cushion. there is no resilience. In 1929, when the jobs vanished, people had zero savings to fall back on. Today, 60% of Americans live paycheck to paycheck. They couldn't afford a $400 emergency expense. If we hit a recession where unemployment goes to 6 or 7%, it won't just be a statistic. It will be a humanitarian crisis. We have millions of families who are one missed paycheck away from homelessness, masking their poverty with BNPL loans and credit card debt. The wealth illusion is about to be shattered. So, let's put the pieces of the puzzle together. We have the new era technology narrative, AI, blinding investors to reality, just like radio did. We have the shadow debt, allowing consumers to fake prosperity, just like installment plans did. We have the hyper-leveraged casino, zero DTE options, turning the market into a gambling hall, just like margin loans did. And we have the fragile society, wealth gap, that ensures the pain will be maximum when the system breaks. We are repeating 1929, but there is one major difference, and this difference might actually make it worse. In 1929, the US government had very little debt. They had the capacity to spend money to try and fix things, even if it took them a while. Today, the US government is $38 trillion in debt. We are running deficits of $2 trillion a year during peace and prosperity. If we hit a Great Depression too, we do not have the fiscal space to bail everyone out again. We printed trillions in 2008. We printed trillions in 2020. We are out of ammo. If the system cracks this time, the Federal Reserve will be faced with an impossible choice. Let the system collapse into a deflationary depression, like 1930, or print so much money to save it that they destroy the US dollar, hyperinflation. They will likely choose the money printer, which means the Great Depression too might not look like breadlines and deflation. It might look like $400 loaves of bread and the destruction of the currency. So, what happens next? What is the trigger? In 1929, it wasn't one single thing. It was a shift in psychology. It was the moment when greed turned into fear. It could be a disappointing earnings report from Nvidia. It could be a small bank failing. It could be a geopolitical event. But as we learned from the Wheelbarrow Man in our Weimar Republic video, the trigger doesn't matter. The explosives are already piled up. The spark is inevitable. This sounds terrifying. It is terrifying, but it is not hopeless. There were people who survived 1929. There were even people who thrived. Who were they? They were the people who didn't believe the new Plateau hype. They were the people who got out of debt while everyone else was getting into it. They were the people who held cash and gold when everyone else was holding margin loans and paper profits. Joseph Kennedy sold his stocks before the crash. He sat on cash. When the market fell 89%, he went back in and bought the best companies in America for pennies on the dollar. He built a dynastic fortune because he wasn't greedy. The lesson of 1929 is not panic. The lesson is preparation. The ghost signals are flashing red. You can see them in the BNPL delinquency rates. You can see them in the options volume. You can see them in the wealth gap. Do not listen to the pundits on TV telling you it's a soft landing. They said the same thing in October 1929. Instead, look at your own financial house. Are you leveraging yourself to buy things you don't need? Are you gambling in the market with money you can't afford to lose? Are you assuming that your job is safe forever? Now is the time to deleverage. Now is the time to build a real emergency fund not invested in the casino, but sitting in short-term treasuries or gold. Now is the time to be boring. The party of the 1920s ended. The party of the 2020s will end too. The music is already slowing down. Don't be the one left without a chair. This is what we do at Finance Prism. We look at the data that others ignore. We study history so we don't have to repeat it. If you want to understand how to protect yourself in the coming cycle, you need to understand the tools of the new era: Bitcoin, gold, and real assets. We have deep dives on all of them on this channel. If you found this forensic analysis valuable, if it helped you see the matrix, hit that subscribe button. Share this video with someone who needs to wake up. And tell me in the comments, do you see the ghost signals in your own life? Do you see friends using buy now, pay later for groceries? Do you see people gambling on options? Let's discuss it below, because the more of us who see the truth, the safer we all are. I'll see you in the next video.